Hey, good morning, traders and investors. Welcome back to the Wednesday Trading Analysis live stream show. I'm your host, Bennett Tyndall. Thank you all for taking time out of your busy Wednesday mornings to join us. We appreciate it. Got a good show in store for you all this morning. Markets, as you can see, bottom left-hand corner of your screen, are slightly positive in the pre-market futures session. We'll see how this carries over into the cash session. When we met last week, we were looking at a downside move in the indexes that we felt was nearing completion. I was hoping to see one additional low out of an ending diagonal pattern. We didn't get the ending diagonal completion, but that doesn't mean that the C wave is not over and we're now moving higher, either in the wave 3 position of the higher degree ending diagonal that we've been tracking, or potentially as a next best case scenario, we would be moving higher in an X wave position. We're going to get to that in just a few minutes. Before we do so, we're going to go ahead and bring in the trading analysis team, see how they're doing today. Good morning, Terry. Good morning, Alex. How are you, gentlemen?
Good morning, everybody. Welcome to June.
Can you believe it?
Summertime is right around the corner.
It's
well,
here.
Technically, I guess the markets think summertime follows Memorial Day, but a few more weeks it's going to be hot. So
we're almost there. It's already hot in Texas, I tell you what. It's humid. It's the tropical season. What's up, Alex? How are you, brother?
Hey, guys. Good morning. All good here. Tropical season as well.
Yep.
Very hot weather. So people are slowly preparing to go on coasts in local areas. So everything's as usual.
Good. Glad to hear it.
At the beach.
That's right. Time to get out and enjoy the summer. We've all been kind of cooped up in our homes with the coronavirus pandemic the past couple of years, so I'm sure this summer will be a season of travel, hopefully, for some. Good morning, Oleg. Good morning, Alan. Appreciate you all tuning in. We're going to get to the charts in just a few minutes. Yep, some interesting moves out there. I can certainly take a look at the Russell 2000. I want to focus mostly on the S&P 500 this morning. We do have a guest coming up in just a few minutes. Any thoughts before we get started, team?
Well, I mean, coming out of 7 weeks in a row decline, we had a pretty big bounce last week. So what are we looking for, Bennett? That's what we want to know. Are we going to see a continuation of this bounce, or is it going to roll over again? I'm sure that's what everybody's thinking. They're asking. Yep.
It's been quite an interesting year. We've got a good look at the hard right edge coming up here in just a minute. We'll take a look at sector rotation, of course, with Terry. If you are interested in crypto, we would encourage you to check out Crypto Lab tomorrow morning with Alex. See what's happening in the world of Bitcoin. All right, gentlemen, I'll be back on the other side. We'll bring in our guest, and we'll go from there. Catch you guys in just a couple of minutes. All right, good morning once again. Let's hit it. Hard right edge of the Motive Wave platform. Let's see what's been going on in the indexes since we met last week. Taking a look first here at the S&P 500. I want to use the S&P 500 to communicate my overall market sentiment. I feel this index provides us the highest conviction Elliott Wave counts, and as a result should be our best guide for underlying sentiment moving forward into the remainder of this year. So first up, I have to kind of remind you all of the discussion that we had it's been a couple of months back when we first discussed the concept of the two actionary waves that I personally see from the COVID low. And really quickly, just to give you a visual of what I'm talking about, for those of you who are new to Elliott Wave, this is a topic of interest. If you're well-versed in the world of Elliott, perhaps this is a bit of a repeat. In an overall motive sequence, a 5-wave trend, there are two different types of motive waves. We have motive impulsive waves, where you have clear isolation between your wave 4 and wave 2 corrections. And you also have motive diagonal sequences. Now, in a 5-wave motive impulse wave, you typically have an extension within 1, 3, or 5. In a 3rd wave position of a motive impulse wave, you need a clear 5-wave trend. But in a wave 1 or a wave 5 position of that same motive impulse, you can have an ending diagonal. Ending diagonals require overlap between waves 4 and waves 2. In the case of the wave 1 position, it would be a leading diagonal in the fact that it's starting a trend, and in a wave 5 position, this would be considered an ending diagonal. So with that in mind, zooming back out to the weekly time frame, we have been tracking an overall motive impulsive trend, a 5-wave structure going all the way back to the 2008-2009 area credit crisis low. And within this 5-wave trend, we see the COVID decline as likely the wave 4 position. As we've looked at previously, this particular wave 4 did demonstrate the guideline of equality in that wave 4 was equal to the time elapsed in the wave 2 of the same degree. So in this 5-wave trend, we have 5 waves in wave 1. In this case, we have isolation, clear motive impulsive trend. In wave 3, we have a 5-wave trend with clear isolation and separation, clearly a motive impulsive trend. Here in wave 4, this is your counter trend corrective move in the wave 4 position. This overall unfolded as a flat. What's interesting is going back to September of 2018 through December of 2018, that initial 3-wave decline we knew was too short to be all of cycle wave 4. So at the time, we were actually looking at this as potentially an overall triangle. COVID-19, as you all know, came along, set the social mood up for a very significant decline, which turned this overall 4th wave into a flat. Okay, great. Where does that leave us now? Moving from the March 2020 low, we have been looking at this as a cycle wave 5 position of a higher degree wave 3. So perhaps we do see a bit of a larger pullback once this overall trend comes to completion. So best case scenario, the way I see markets, first of all, let's now get off of the daily, or excuse me, the weekly, and focus in on this trend on the upper right-hand corner on the daily. Going back to our discussion regarding the motive impulsive trends versus motive diagonal trends, in a leading or ending diagonal, you can have a 3-wave subdivision in a wave 1, a wave 3, and a wave 5 position, unlike the motive impulsive trend where you need the clear 5-wave move. So what that means for us is going back to the COVID low. If I'm right, and the first actionary wave concludes September 1st of 2020, which, by the way, you'll notice this green trend line. That green trend line is the Elliott channeling technique that's derived from our cycle degree of trend. So if I'm right, and that makes our first actionary wave, which it, by the way, is then met with the largest percent correction that we have seen or had seen from the March 2020 COVID low. If this is our first actionary wave and this is our first corrective wave, then the 5-wave trend that follows into early January of this year is the second actionary wave. So why is that important? This is a 3-wave structure, and as markets were moving lower in this corrective trend, there were many out there that were suggesting this to be the end of cycle wave 5 and the start of a more significant bear market or distribution move. With number one, a combination of our upside fib objectives, as well as pulling back the curtain and looking at the sectors, the rotations, we feel that this is simply a 3-wave trend. So what that means is a 3-wave trend in this instance likely occupies wave 1 of our higher degree wave 5 ending diagonal. That is still valid even if we do see markets push lower. So best case scenario, we just completed a 3-wave pullback to occupy now wave 2 of the higher degree wave 5 ending diagonal, and we're going to continue in a 3-wave trend for 3, another 3-wave pullback in 4, overlap, and then a move up in 5 to complete the overall sequence. Zooming in on this particular trend channel, you'll notice here that we, yep, absolutely. Zooming in on this particular trend channel, you'll notice the area of resistance offered from that cycle degree trend channel is now being tested. You can see this line that I have drawn as price action has met that downside channel. So this is the first instance of a back test following the breakout which occurred in November of 2020. So this is best case scenario. Now let's get off of the daily and focus in on the upper right-hand corner of your screen. We'll go all the way down to a 1-hour chart. Looking at the 1-hour chart, we have a 3 or 5-wave move. It's a bit tricky. I see it as 5 waves into February, 3 waves back into late March, and an unusual 5-wave completion in C. The reason I say it's unusual is the subdivision is a little bit forced, which is why last week I was looking for the ending diagonal to give us one additional low in the index and then look for this upside move. Now, in regards to our discussion last week about the time elapsed in the C wave compared to the A wave, while we often do see a C wave not be as significant of an angle of ascent or descent compared to the A wave, the more important technical level, in our opinion as Elliottians, is simply the corrective trend channel and the equality price projection. So the corrective trend channel takes the high from January through the late March high. That's where your trend line is established. Your parallel trend line is taken over the low of February. And you'll notice here, as markets met that downside channel, we did see a bit of an overthrow, and we also exceeded equality. Now, overthrow in this market is not surprising given the uncertainties and the sentiment fluctuations that we saw along the way down. So this is the more important zone for establishing this overall trend as a correction. If we can continue to put up a fight and see a 5-wave print to the upside from here, any sideways to lower corrective trend will at the very least pave an upside zone of opportunity for an equality rally. What do I mean by that? Well, remember I said best case scenario is we completed wave 2 and we're now going to move higher in wave 3, 4, and 5. Next best case scenario would suggest that that 3-wave decline into May 20th is simply the first 3-wave move of an overall 3-wave correction, which again, if we can confirm the upside motive trend that we've seen from last week with some sort of a corrective trend, that would at least present an upside zone of trading in a C wave position of an X wave move. So this is next best case scenario. These are my two preferred overall market trends. If we can confirm this sideways consolidation, that will establish some clear zone of upside trading. Now, what's the worst case scenario? I have to at least put the worst case scenario in front of you, as we need context in the event these plans don't go in our favor. The worst case scenario, as we looked at last week, and I believe the week before, the worst case scenario suggests that the first 5-wave move into February was either 1 or A. The move back into March was 2 or B. But the more important takeaway to this alternate bearish scenario would say that 5 waves actually completed into the 12th of May. And if 5 waves completed into the 12th of May, that would explain the 3-wave rally into May 17th from the 12th. That would also explain the 3-wave decline to the 1272 external retracement of the A-wave rally. And that would also allow for the motive trend that we see here in the C wave. Now, yesterday's S&P index high was 4168 and change. The C versus B 1272 was 4170. You'll notice that zone of resistance happens to correspond with the March 8th and March 14th area low. That zone at 4157 acted as support for the rally up. It also acted as support back here in the 3rd wave. So these are the key zones of interest on the alternate bearish scenario. The alternate bearish scenario would suggest this is simply a flat and we go lower from here. I'm going to let the market decide, as if this is a flat, I think we'll see clear rejection from here. Whereas if plan A or B of the best and next best case scenarios are really at work, this 5-wave rally will be met with a correction, a consolidation, as opposed to a motive rejection to the downside. Now, before I go, I want to show you 2 additional charts. Yes, I'm going to take a look at the Russell 2000. That will be a quick overview. But the chart that I want to look at that really, in my opinion, best illustrates the ending diagonal scenario in the S&P 500 is the index, or excuse me, the sector of consumer discretionary. Consumer discretionary, along with technology and healthcare, a dominant portion of the index. And what we've been looking at here for consumer discretionary is a, in my opinion, fairly clear ending diagonal trend. You have a big 5-wave move up. It's a bit of a disguised 5-wave move. but you have a big 5-wave rally from March of 21, a sideways consolidation, and then guess what happens from there? You have a perfect equality projection. Now, one issue we've always had with this count is the size of orange wave 5 compared to the rest of this motive trend. But what if, in fact, the ending diagonal that we see here of the expanding variety is actually a C wave? That would give us a much better look. This would follow the guideline of the right look. We would have a much more proportional C compared to A relationship. 3 waves would complete wave 1 of the higher degree wave 5 ending diagonal. That would allow for this big wave 2 shakeout, then the move up in 3, 4, and 5. So I think the chart of consumer discretionary, should it continue to confirm trend, will help to support the ending diagonal overall view in the S&P 500. Finally, the Russell 2000. Looking at the Russell 2000, we are on a 195-minute time frame. Here for the Russell 2000, while the C wave did pretty much meet time equality into about less than 50% of time elapsed compared to the A wave, as mentioned, the corrective trend channel and the price equality projection is the more significant metric or technical level that we should be interested in. And you'll notice here the corrective trend channel and the equality projection has staged a bit of a reversal here. So plan A, ABC is done. Plan B would suggest that this is also just a wave 2 correction, meaning for the Russell 2000, 5 waves also completed on the 12th. This is just an ABC retracement. Checking the questions here. I'm going to hold off on Apple and NVIDIA, and here's why. Right now, we're up against a situation where we're awaiting confirmation from the broader indexes. And within Apple specifically, there are multiple valid Elliott Wave counts. I don't see Apple is currently bearish, even with its move under price equality of the initial decline, the C versus A discussed last week. So do me a favor, let's hold off on that discussion. Let's see how the rest of this week trades out. And I promise I will present those charts next week. And I'll also probably put out a public video later this week if we can gain some additional clarity on the indexes. Once the indexes confirm that 5-wave rally, should they confirm the 5-wave rally, we'll be all after that particular move and can further analyze NVIDIA and Apple. All right, so that's it from me. We're now going to take you over to the Advisors Corner with Mr. Todd Gordon, co-founder and director of investments at New Age Wealth Advisors. Good morning, Todd. How are you today, sir?
Hey, Bennett. Hey, team. Good to have to be back. And come on, man. I'm always founder of trading analysis. So always my baby. Come on. You're dropping my title already.
Oh, my bad. My bad.
No.
I should have included it too, you know.
No, man. No, it's just listening to you go. Like, you just, the level at which you're operating now, like, you're my go-to guy with wave stuff. Like, you've taken what, like, you know, not in any way, you know, what I started, and I think kind of got you guys on the path to what you're doing, and you've certainly exceeded where I left off. So congratulations, sir.
I had a good teacher. Love the waves. You know that.
I know you do. You're good. So hey, again, thanks for having me. And I just want to pick up where you left off. We made some adjustments. So real quick, those of you who don't know, I started trade analysis, formulated this amazing team. The idea was to have a short to medium term trading advisory business like this operate and exist next to long-term wealth management, and that's what's been done. So just coming in and follow up after what Bennett was saying, what an unusual position the market is in right here. You can hear Bennett going through looking at multiple wave counts that at the heart of it, if it is in fact a larger ending diagonal, we need to, you know, especially with people with longer term portfolios, we need to be very aware of that and maneuver. But the fact remains, I think we can all agree, Bennett, right, that we probably just saw a 3-wave move down from pretty much November, or different in some markets, the end of 21 down to the last couple of weeks. It looks like a 3-wave move, right?
Yep, I would agree with that, certainly.
And the one thing that I'll push back on, and this is not calling Bennett out as well, is in the Elliott Wave world, you always, as long as somebody has a valid interpretation, applying the rules properly, and the guidelines are acknowledged, you never say a count is wrong. And the one guideline that I would look at is the one where you're showing that it could be wave 2. This could be a wave 2 rally up. I think it's in less than a daily time frame, the S&P. That was a specious wave 3. I think you had sort of an irregular correction within wave 3. You know what chart I'm talking about in the S&P?
I believe so, yes.
And that's the only reason it's not wrong, but it's a little bit against the usual guidelines that you look at. It really, even with a shorter wave 3 like you had, it looked like a 3-wave move.
Are you talking up from the COVID low? Or you're talking wave 3 on the move down?
Wave 3 and the move down.
Okay. Yeah.
I don't know if you want to pop that back up. I think it's relevant to the conversation. Can you do that quickly, or sorry to put you on the spot?
No worries. Let's see here. I can't bring us all in, but I can do this. Let me bring my motive.
That's fine. We
window.
just show it real quick and then bring it back in. I think it's important in the conversation.
Yep. Let's do this. You're going to be muted for 2 seconds. All right, take it away, sir. What are you seeing here? Let me get you.
Yeah. Just, where was that? Okay, yeah, go inside. Give me more detail on that 60-minute. Get like a 30 or 15-minute. Yeah, so stretch it out a little bit. I'm talking green. No, that's not the one I was talking about. That one right there. Yeah, inside of orange 3 within green 1.
I completely agree. Yeah, let's do that. Let's go all the way down to 20 minutes.
That it's not wrong, but that I would say is in net percent distance traveled in circle 3 compared to 1 and 5 is what?
We just exceeded equality.
Okay. It's not wrong.
And then wave 5 was.
You know what I'm saying?
Yeah. Oh, absolutely.
The time elapsed in wave 3. It's not only price, but it's the time elapsed. It's the x-axis was very short compared to same degree 1 and 5.
Yep. Don't disagree with that one at all. So
wrong. Yeah.
Would you be more inclined to entertain a complex view of March through May?
It reeks of C wave to me.
Yeah.
Where the final wave, the final motive, the final structure, the final C of an ABC correction. It's the final motive wave. C is motive within an ABC correction. I kind of don't care what happens in there because it's sort of laboring to a new low. Volatility was not making new highs. Selling interest was waning, and I find that last pattern, like wave 5 of 5-wave move or C of an ABC, can kind of do what it wants because it's just showing you it's getting tired and discombobulated.
Yep, don't disagree with that at all. A good example, Todd, of that would be going back to our COVID sell-off. The C-wave move there didn't really have a clear 5-wave completion. You could have argued there would be one additional low before the rally set in, so that does fit well. Now, I will also push back on that then and say, how do we arrive at a completed C-wave with a 3-wave move clearly from May 17th through the 20th? The only way I can figure to do this is to call this overall trend a diagonal, which technically it's valid because 3 is shorter than 1, 4 is just barely shorter than 2, and obviously 5 is shorter than 3. But I think this is also a bit forced. But to your overall point about a C wave, it does fit. It fits the characteristics.
So wait, why can't that? And I'm sorry for I really intended being in and out of here out of 5 minutes. But I think it's central. Why can't that C wave be a diagonal?
It is a diagonal. This is essentially how I have it to allow for the 3-wave completion here, but there's no other way to. You can't call this 1, 2, 3, 4. There's no overlap. So the only way to it's basically the only valid diagonal would be forcing that move down in 1 back into 3, 4, 5.
And I think if you look at the weight of the evidence of your implications, if it's wave 3 down of a new downward a new down motive wave, a bearish motive wave of significant proportions, the irregular behavior of 3, I think, is more important than sort of a specious final wave of an ABC.
Yep.
I think there's more weight of the evidence if you're going to call it a downward bearish impulse in wave 3 than the final C wave of a correction, if that makes sense.
Totally makes sense. And that overall supports kind of our view that, this is likely not the start of a larger trend. So
right,
I like it.
Right.
Great
Okay.
discussion.
Yeah, no, thanks for engaging me on that. And,
Yeah,
and this is what I wanted to talk about. I'm just, I'll take the screen if you don't mind.
Yep.
I'll make this point real quick and I'll move on. I know we got Alex and Terry here. We're running money, right? And we've got 2 main portfolios. We've got New Age Alpha, which is a growth focused portfolio, and we have Tactical Dividend, which is a dividend player. Has to meet certain fundamental criteria and of course technical criteria as well. And we recently made a move in the New Age Alpha, which is essentially the growth portfolio, to get protective. And it really hinges on the discussion that we're having right here. And basically what I'm going to show you, I'll show you inside the portfolio. We did raise cash here and actually got a little defensive. But the fact remains is it is an ABC correction right now, whatever the higher degree is. If this is a wave 4, if this is 2 of a diagonal, is what Bennett was saying, it almost doesn't matter, because I think we can all agree that this is 3. Sentiment was horribly, morbidly bearish, even worse than the COVID lows. We're talking credit crisis lows sentiment. And that equates to a move higher. You look at S&P, you look at the NASDAQ, and the fact that we had 2 equal leg moves. This was 22.5%. This was 23%, right? And 100%. A equals C right there. We're starting to move higher. Same thing with SMH, semiconductors, which is interesting. We didn't even get to the 100%, depending on where you put the A wave. 100% is right there. You look at stocks like Microsoft. There's a lot of evidence that we saw an A equals C decline. And this was perfect in Microsoft, right down to 249. So, running money, we have a tactical dividend portfolio, which has shown very good relative strength to the benchmarks. But we did something interesting at the support level in the event I'm wrong. And basically, I'll show you here real quickly. We raised cash. Okay, I went to, oh, that's not the one. Sorry. Give me one sec. I'll show you the actual portfolio here. Growth. Okay. So here's the actual sector allocations. And what we did is actually raise cash. So I went to 10.25% cash in the growth. And I also put an inverse ETF in. I put a 4% allocation in inverse ETF. And this is the discussion I had with clients. And this is the discussion that we're all having now. I see support. We know sentiment is extremely bearish. We're starting to see evidence that the Fed's not going to do a bunch of consecutive 50 basis points. And we started to show support. So for those people who are in the same position where you have growth exposure or tech exposure, I am willing to forego performance in the event that we do move back up. And we do just complete this ABC. We go to new highs. I think that's what we're going to do. And as I said, I'd rather leave this cash in the sidelines, miss out on 10.25% of upside participation, take a loss in the inverse ETF, and then move on with it. I think the sell-off in tech has been so vicious that I think that's important. But it's certain kinds of tech that you have to be aware of. You look at SMH again. Just look at SMH compared to the S&P, right? This is SMH into the S&P. We've actually seen relative strength in the month of May. Semis are stronger than the S&P in here. Like, what? Like, inflation is through the highs. No one's talking about a rotation back into growth, and yet semis are outperforming. So basically what I'm saying is I am putting safety over our tech positions. And any of you who have tech positions, this is kind of what I'm longer term tech positions, not trading is what I'm talking about. The other thing that we're doing in here is trading analysis is built on solid technical fundamental, but also proper vehicle selection. And one of the things that I'm doing, and I'll just throw this out here quickly, is we're doing a hedged equity strategy. So besides our tactical dividend, New Age Alpha, we're doing a hedged equity. And basically what it is it's a way to gain additional equity exposure in your portfolio that would perhaps take place of part of a usual fixed income, because you have yields, at 3-4% in U.S. Treasuries now, but inflation's running 6-7-8%. You're still losing money. So we have to find ways to get additional equity exposure, but do so in a risk-controlled manner. So we're doing this using options. And I'll just show you this real quickly. This is essentially what we're doing is you're holding an ETF like the SPY, but we're doing downside put spreads every quarter. And then that's going to be a debit purchase and then selling an upside call against it to help finance it. So it's sort of like a guardrail hedged equity, and actually have a setup. I'll just show you what it looks like here on Thinkorswim. I know you guys are very used to options. So this is one particular setup that we did. Let me get rid of price slices here. So what we're doing here is we have several clients who came in at this exact size, just wanted to put like 100,000 to work. So we put 200 shares to work last week. And then what we did is came in and did some put spreads. So I'm trying to stretch this out. So basically, come on, baby. I don't know if I can get it. It's a small screen. So basically what we're doing right here is buying. We went out to July at the end of the quarter, buying a 375 put in the SPY, selling a 335, and then selling an upside 440 call. And that kind of gives you this price structure here. The left is the profit and loss. If we move down, you could see that the teal line is actually your profit and loss at expiration. It actually moves up. So, with an $80,000, $100,000 account, with the market down at 335 in the SPY, you can see in teal, you're down $4,300, which is roughly 5%. But if the SPY is at down 334 from where we are now at 4 and change, it's a much bigger percent loss. So the point in doing this is, you can use equities, you can use options, I can say, to help sort of get extra equity exposure, but do so on a more risk-controlled basis in the event that this A equals C big debate that the team is having doesn't hold. And I can hear the bearishness. You can take the charts off, Bennett. I can hear the bearishness in Bennett's voice, and not, convinced that we're going to continue to move higher here. And I think that's valid. A lot of people are looking for another leg down. So I think it's prudent to have equity exposure. But if you're looking for additional equity exposure, using options is a very good way to sort of put guardrails on it. So I just want to throw that by you guys.
Excellent. No, I like that view there. It's a good strategy. And regarding your mention of my slightly bearish sentiment or perhaps skepticism, I'm smart enough to know I'm not smarter than the market and to be aware of all possibilities.
You're finally using my line, and that is my line to give to you. And that shows me that you're now a market veteran. You got to just be humbled and kicked in the pants enough to say that. Say, look, the market can do anything it wants. Our job is to assess the now, to know as much as you can about what's happening now and know the limitations of our inability to predict the future and be completely fine with that. And that's EQ. That's emotional intelligence. Good trading and investing isn't about IQ, it's EQ. It's controlling your emotions and controlling and focusing on what you can control. Put yourself in the best position today. And then let tomorrow take care of itself. If you've done your work today, you'll be fine.
Absolutely. Very well said. Todd, appreciate you joining us. And we'll have you back soon, hopefully.
Yep. I'll be back more. You can find us at newagewealth.com. Trade analysis team will take care of you on the short to medium, as you know. See you guys.
Thanks, Todd. Appreciate it. We'll talk to you in a bit.
Todd.
Take care.
I'll be here listening, guys.
All right, team. We've got about 4 minutes to market open. You can see futures pushing slightly higher. Mr. Terry Long, you ready to take us through Optima and take us through sector rotation?
Let's go.
All right, let's hit it. We will be back on the other side to take you through the macro scene. Catch you in just a couple of minutes.
All right. Hello, traders and investors. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So I hope everyone had a happy Memorial Day. Now, as you know by now, the market's finally caught a break after a record-setting 7 weeks in a row decline for the S&P and the NDX. Both indexes resolved significantly higher last week. Now, with huge gains here in the consumer discretionary, energy, financials, and technology sectors, the S&P rallied up from the bottom 6.58% last week. The NDX saw an even larger weekly gain, up 7.15%. Now, this move pushed both of these indexes back above the prior week's highs. You can see that move right there on Friday, actually taking out the prior week's highs in both of these indexes. Now, all 11 sectors rose sharply last week. The best performing sector came from consumer discretionary, which we all know has been dramatically beaten down. This netted a 9.5% gain on the week. Energy rose 8.3%, followed by financials up about 8%, and even technology sector up 8%. So you've got two big growth sectors in here with two value sectors. Now, the worst performing sectors were healthcare and communications, but even those were up over 3% for the week. All right, so since Monday was a holiday, we only have price action for Tuesday to set the stage for what's going on this week. Now, following last week's spectacular pushback to the upside, the S&P started the morning off with a move lower and then sluggish rise, I thought, throughout the middle of the day, only to end the day down just 0.63%. Now, the NDX followed a similar pattern, but it ended the day only 0.31% lower. Now, the consumer discretionary sector was the only sector holding positive gains on Tuesday. Overnight action, I think, has pushed these financials and staples. Either that or my data when I wrote this was wrong. Let's look at it right now. Live action right now, and the market bell is about to ring in about 15 seconds. XLY up 1.18%, financials up 0.98%, staples 0.85%, technology up 0.3%, utilities, communications, and real estates to the downside. All right, over to our relative strength sector leader scoreboard. The energy sector remains the relative strength leader. Now, one thing I want to tell you, when all 11 sectors rally broadly, I do not expect to see noticeable change in sector rotation. For now, most sectors are continuing to perform relative to the benchmark S&P as they have been for the past several weeks. The utilities, staples, healthcare, materials, and real estate sectors continue to remain here in the leading quadrant. Healthcare, real estate, and industrial sectors are actually seen with declining vectors. The real estate sector is rotating a little bit counterclockwise with some relative strength gain, but you can see the momentum fade there. The industrial sector continuing down. If I pull this tick back one little bar there, that's going to be, this is Friday's close, okay? And so Tuesday's price action adds just a hair in there, a hint as to where the week is headed, but it's not confirmed, and obviously until we get to Friday. Now, staples sector is still showing rising momentum and relative strength combination. Healthcare is still seeing some relative strength, but a little bit of fade in momentum. Okay, over here in the lagging quadrant, that same analysis here, the financial sector, look at there, just while we were watching it, the financial sector now is turned with a blue weekly improving price trend, and it is seeing some northerly motion. So northerly momentum has been occurring for about the last 4 weeks here in the financial sector. Technology also has a northerly trend here, and the consumer discretionary sector has actually been the one that's been fading. But we do see here a bit of a attempted reversal hook starting to form. Again, too early to confirm since that last little line segment is not official until the end of the week. The communications sector finally poking its head out. It's been a long time sitting here just kind of stalled. It's starting to slowly navigate its way back into a northeasterly heading, and so that's kind of a positive situation. So I'll tell you, that big reversal happened right here following the 7-week decline here. I'm going to look for how far up we get on this corrective move, this bounce, from this corrective move. And you just heard Bennett and Todd go at it, comparing their analytical techniques in Elliott Wave as to giving us conviction onto which of those cases. So, all right, I think once the market actually starts moving in a new uptrend, that's when we're going to start to see more significant developments here in the RRGs. That's all I have for you. Now back to Bennett.
Very good. Much appreciated, Terry. I'm anxious to see communications do something, man. It was like that move up from lagging towards improving on the weekly, and it just kind of hesitated there for a bit. Might finally be ready to pull itself out of the weeds. All right. Alex, sir.
Alex, you're not in GoToMeeting. I can't give you the screen.
Oh, just a sec.
We'll get you set up there for that. Markets, as you can see, are open. Taking a look here at the S&P 500, currently 4162 in change. I think within the 5-wave move, I didn't get a chance to discuss this, but from the 5-wave move started last week, whether it's C of a wave 2 flat or upside resumption if it's confirmed with the correction, that 5-wave move, it looks like yesterday was a wave 4 ordeal with another move up here in 5, which could be in development as we speak. All right, we're going to get the screen your direction. We'll take you through the macro scene. If you're interested in any crypto-specific coverage, tomorrow morning, same trading analysis YouTube channel, 9 a.m. Eastern for Crypto Lab. All right, you ready to rock,
There
sir?
we go.
Yeah, all set.
All right, take it away, and we'll be back on the other side to wrap up.
Okay, guys, so let's start with a sneak peek of the Bitcoin chart for tomorrow's stream. We have a pretty good track record back in 2017-18. You can revisit that in my Twitter page. I have published all of our calls in the last couple of years. So we do see a good discussion here compared Bitcoin chart with stocks. So there is also a couple of elements that Bennett mentioned, which kind of agrees that we should also see potentially this ending diagonal or a complex correction down to this 2022K, which actually looking the correlation between the mentioned SMH or the NASDAQ with the Bitcoin do suggest either a completely reversal, of course, which we will see Bitcoin goes over 40K and continuing on the upside in 5-wave move, or just a simple corrective pullback, and then that will be some type of an X wave that Bennett just discussed, and another move lower until we post the final low. So if you want to see more of that, please join Crypto Lab tomorrow. I will go a little bit more in depth on the Bitcoin and Ether charts. So let's switch to macros. And let's look what's going on. Situation is not much changed. We have a next Fed meeting on the 17th. Pretty much 96% of the market thinks that we are going to see 50 basis points, maybe even in July. But there is some signs that inflation might peak out around August. So we will see about that. So I do see a pause. I'm announcing that for the last couple of weeks. Yields are not, of course, moving that rapidly, so that this can manifest so quickly. So we will see this potential resistance area, which comes from this 40-year chart. every time we came to the highs of the RSI, we did pull back, as you can see. So we can also count a 5-wave sequence here, which potentially has one more small push on the upside, challenging these levels between 3.2 and 3.4, and then we see some type of reversal or a pause in rates, which might last a couple of weeks or a couple of months. Actually, we see that here in the couple of other charts, which I will show you. So let's look first the European situation. So this is the German Bund, equivalent to US 10-year yields. So as you can see, we are starting to develop a 5-wave move on the upside. Yields in Europe are a little bit late, and the ECB, of course, is still doing QE, 20 billion a month, I think. They announced they're going to pivot in September, so we will see about that. Definitely they will change at least some type of a rate hike or announcements of the rate hike in the next meeting in September, and they will probably limit or cancel their QE program. So if this develops in 5 waves, that pretty much means that situation will be prolonged for a couple of more months in the yields moving on the upside. So if we do see a 5 waves up, a 3 waves pullback, we can expect one more hit in rates on the upside in Europe. Can Europe cope with that, with this geopolitical situation? I'm not so sure. Maybe situation will change there during this couple of months. We will see that. But for now, we are seeing a potentially a 3rd wave developing here, pullback in a 4 and 5. So when we have a 5-wave sequence, if we don't have conditions for a potential flat, which we still count as a counter trend, we do look this to be at least a pullback, if not a new uptrend. So still the question is, are we in the secular, still deflationary environment, and this is just a cyclical a pause in inflation, or the structural secular inflation will change? I think nobody can answer that question currently, and we will still need to see how the situation will develop in the next couple of months. Dollar is correcting as we were looking for the last couple of sessions. We do see a 5-wave sequence developing on the higher time frame. If I switch to a lower time frame, we will see that we do miss one more push on the upside. So we do think this is a 4th wave pullback, maybe a consolidation, maybe a triangle, maybe a complex one. We will see how that will unfold, but we do see dollar going one more leg higher before we see at least a corrective pullback. So dollar can reach a modest target between 106, 107. The really higher target will be pretty nasty side, because dollar index with this 1618 extension and a couple of ratios we usually do for clustering has a target between 111 and almost 14, which I think it's not going to be welcome in any part of the world economy. So I will go more for a modest 0.38 price rejection, which comes around 107, 108. So I will anchor that possible 5th wave on the upside there, looking this still as a 4th wave correction with one more push on the upside. So a month or two more. And that's also, although looking for a 10-year period, Bitcoin and the dollar do not have a great correlation. They do have a rather solid correlation from the COVID start here, if you overlay these two charts, but on 10 years period, they have 0.6 or 0.65 correlation, which is not enough to consider that an inverse correlation. So we do have some degree of a better correlation than in the last 2 years. And looking for this chart with one more dollar move on the upside, we might see this 2022K tested as we think. So let's switch to some commodities. Oil is still trapped in this sideways consolidation, which we still look as a potential triangle. We are trading at 118. European Union announced embargo on the imports of oil from Russia. We do see this still between the very wide range from 95, let's say, to 130. As you can see, we have seen the previous consolidation back in 2011-10, forming kind of a sideways pattern in the same manner. So this might happen here again. We might have, as long as we stay in this range, a consolidation before we start pushing further on the upside, because we do see, or I do see this as a still unfinished uptrend in the overall chart on the weekly time frame. And some of the targets are pretty large. We have spoken here a couple of months ago for 137, 140, and we were trading at 90, 95. So it was not very easy to imagine that price, but we of course didn't know that the war will happen. And actually we had reached that target. So I will stay with this wave count, looking for still a longer consolidation and a possible pop-up in the third wave, then a little bit more of a pause, and then a finalizing five-wave move on this larger time frame, which will be interestingly a cycle wave 5 if you look this chart. So if we go back, you will see that this goes from 1962, and there is clearly a five-wave move to the upside with the target around 230 to 236 area. If we switch to the net gas, we are stalling a little bit around our targets, maybe from here, maybe a little bit more on the upside. RSI is diverging on weekly. That is something that we look for, a possible weakening of a trend when we have the higher prices in the intermediary degree of the wave 5 and the divergence there, which is still very visible. So I do see a potential pause in the fourth wave starting in this is the Henry Hub futures. So there is a wave 1, wave 2, 5 nice 5 waves up in a wave 3, potentially here or a little bit more upside around, let's say 10, 10 and a half. I do expect a pullback and then a finalization in the couple of months of this wave 5 on the upside, probably in the winter. We all know this winter in Europe will be a tricky one, especially if the war will still be on the European soil between Russia and Ukraine. So that might pose a higher consumption, higher prices, and we might see this fifth wave further advancing on the upside. So Thomson CRB index, 35 commodities. So still the same picture. I do see a pause. We are tracking this 5-wave move on the upside, which is very exhausted. I think this is the wave 5 and the ending sequence of this wave 5. I think it's pretty much there. Maybe one more small push on the upside, and then we will fall, I think, either in some type of a triangle or a complex correction, which will make a pause in the price of commodities on the upside, ease up inflation, produce a little bit more upside in equities, and then we will be facing with the next move on the up in commodities, which might get, again, this inflationary picture a little bit higher than anticipated. So let's look at gold and silver on the end. Nothing particularly happens in gold and silver. We had a small bounce. I cannot qualify this as a 5-wave move on the upside yet. As you can see, this is not enough actually to anchor this wave 2 here. We have reached 88.8% retracement. A little bit unusual. We usually look that for a flat, and when you have a 786 pinched, it's not so grave, but we like to see 786 holds. Of course, we need to see 5 waves up actually to call this a wave 2, and for now the answer on the upside was not so strong. We have to go to a smaller time frame to see if we can call this a 5-wave move on the upside, and I don't think still we can. There is a wave 1 and 2 up in 3, 4. We have an overlap, so either this will be an expanding leading diagonal, or we will actually have just a 3-wave move and continue further lower towards these targets that we have, as you can see here, which actually puts gold in a flattish or a complex correction down to 1,670, where is going to be the next level of support. You can label this WXY. That will actually mean just a difference how this will C wave or a Y wave will unfold. It will have just a different pattern in a sense of moving on the upside. We will have a 5 waves down in A, up in B, down in C, or otherwise straight 5 waves down in flat. So that's just a different, but the context is the same, the target is the same, and the equality between this flat and this wave 4 will be the same around, let's see, September of 2022. So let's see how this will go. Silver didn't also progress much. We are still bouncing off of this 400 days and even more support line. Also, you can label this as WXY. I like this A as a leading diagonal up in B. I also had this as an X wave. We warned a couple of weeks back that this is just a 3-wave move. We didn't see and identify a 5-wave move, and therefore we warned this might go lower, which actually did happen. So that's why Elliott is such a powerful tool. It can keep you out of the markets. And as I remember, the media and the market was very bullish on silver at this moment here. So we didn't see a 5-wave move. We looked for a move lower, and we still do. This is still not enough to call the reversal. We will need to see 5 waves up, challenging these levels on the upside. And from that perspective, I don't think people need to rush into it. I mean, usually we are biased to catch some low or highs, but it is not very lucrative game. In trading, it is much more wise to wait a little bit of a confirmation, and then you're going to have a pullback with a bigger probability and a smaller risk to catch this further potential outside development and beginning of a new uptrend in silver. So I will wait until I see 5 waves up, and then pullback will be my preferred place for the possible longs on gold and silver. So that's it, guys, from me. So back to you, Ben.
Very good. Much appreciated, Alex. Excellent work, Terry, Alex, gentlemen, as always. We'll be keeping our eyes on the developments in precious metals. 2078 in gold, potentially just a corrective rally. Only time will tell. Appreciate you all tuning in with us today. Again, if you're interested in the crypto side, please check us out tomorrow morning, 9 a.m., Trading Analysis YouTube channel with Alex for Crypto Lab. Members, we'll see you in about 10 minutes for our weekly member webinar. Viewers, we'll be back same time, same place next week. Hope you guys enjoyed your extended holiday weekend. Get out there, check out Top Gun. I haven't seen it yet. Got to go see it. Got to go see it. I've heard a lot of good things about it. All right, we'll leave it there. If you did enjoy the content, please subscribe with notifications. Give it a thumbs up. Let the YouTube algorithm know to distribute it accordingly. Any final words of wisdom, gentlemen, before we let them get out of here and enjoy the rest of their mornings?
That's
See you guys.
All right, sounds good. We'll keep our eyes on the hard right edge. Check us out, tradinganalysis.com, and we'll see you back next week. Have a good one. Take care.